Researchers are actively combing historical data to enlighten us on the causes and consequences of concentration of wealth among the few. Recently, I was asked by the Forum Committee of a retirement community to review a recent book by Robert Reich called Aftershock that highlights the wealth gap. At the time, I was reading another book called Fault Lines by Robertson that also addresses the issue. This presentation is a summary of what I said at the forum, including a look at some other recent research. It turns out that both books have the same thesis. The authors postulate that the Great Depression of the 1930s and the recent Great Recession were caused by income inequality. These authors think that people who are falling behind economically borrow money to speculate in markets. And when the speculative bubble bursts, the markets crash, consumer spending declines, and unemployment increases. In the 1920s, there was a great growth of stock prices, partly due to the booming sales of automobiles, oil to fuel them, telephone services, and other consumer products. Millions of ordinary people bought stocks on credit. When the stocks became greatly overvalued, and those knowledgeable in stock values began to sell, people who had bought on credit were required to sell to cover their debts, leading to a general panic and a crash. In recent decades, house prices soared as people who could not afford houses bought them on a variety of credit schemes, and many who already owned houses borrowed against them to the point that they couldn't afford the interest payments. The house price bubble burst, causing the Great Recession, lowered demand for consumer goods, and high unemployment. Although one can argue that at least some of the borrowing that preceded the two crashes can be attributed to simple greed rather than trying to keep afloat economically, there is a remarkable parallel in increased income concentration among a few during the period before the crashes. During the 19-teens to the 1920s, 1% of the workforce received an average of 17% or so of the income. When income taxes were increased to pay for programs to stimulate the economy during the Great Depression, and subsequently to pay for World War II, the 1% of the population's share of income fell eventually by more than half, to about 8% of income. During that period, the maximum tax rate on the wealthy, after deductions, was near 90%. For the past 30 years, the 1% share of income increased steadily until it reached a similar point to the 1920s. Then came the crash in home prices that brought on the Great Recession. The incomes in this chart do not include capital gains that go disproportionately to the rich. This chart actually understates the wealth gap because it excludes capital gains. The emphasis on the 1% apparently became the basis for protests in the streets by groups calling themselves First Occupy Wall Street and subsequently Occupy several areas of cities around the country. While the goals of the members of these groups were diverse, the basic idea is that wealth is inappropriately distributed. Actually, the emphasis on the 1% is misguided because the concentration of wealth occurred in a larger segment of the population. The top 20% of the population owns about 84% of the assets, such as income, stocks, bonds, gold, and value of real estate. And the population on average is ignorant of that fact. When asked in a survey, respondents estimated that the top 20% owned an average of less than 60% of wealth. The ideal, the respondents answered, would be for the top 20% to own 30 to 35% of assets. There's a large gap between reality, perceived reality, and what people consider the ideal. Many people do not resent the increase in wealth because they believe there is equal opportunity for people to better themselves. Rajan notes a poll that found 71% of Americans believe the poor have a good chance of escaping poverty, while only 40% of Europeans share this belief. There actually isn't much difference in the countries in upward mobility. Defenders of the wealthy in Congress and the media often yell class warfare when the Occupy demonstrators or researchers point to concentration of wealth among the few. In a telling quote from one of America's most wealthy, Warren Buffett, in 2006, quote, "There's class warfare all right, but it's my class, the rich class, that's making war, and we're winning." So what caused the increased concentration of wealth in the past 30 years? Rice points to the increase in productivity within large corporations that was not accompanied by increase in worker pay. During the period from World War II to 1980, increased worker output per hour was rewarded with increased income. During the past 30 years, however, increases in workers' paychecks have not kept up with the increases in their output. During the past decade, worker productivity increased an average 2.5% per year, but worker pay increased only 1.1%. And where did the increased profits from increased productivity go? To the top echelons of the corporation. In 1980, the average compensation of chief executive officers of companies in the S&P 500 was 40 times the average of blue-collar workers. By 2010, the average compensation had ballooned to an average $11.4 million per year, 343 times that of blue-collar workers. The corporate income from increased productivity of average workers was primarily distributed to the top rungs of the corporate ladder. Rice says that the worker-owner bargain of the past needs to be reestablished. Increased productivity results in increased worker income. The trickle-down theory doesn't work. There was no trickle-down as the rich got richer. There was a flood up. So corporations can't afford to pay their workers more or hire more people. Many are sitting on huge piles of cash. The corporations in the major growth sectors of the economy, software companies, semiconductor, technical hardware, and pharmaceutical manufacturers, were sitting on hundreds of billions of dollars of cash in 2011, and that is expected to increase in 2012. The consequences of wealth concentration among the few is a stagnant economy. Middle and lower income people spend a much larger proportion of their income than the rich, but you can't buy cars, homes, TV sets, and computers, not to mention food, if your income is deficient and declining. In 1914, Henry Ford shocked other manufacturers when he doubled worker pay at Ford Motor Company. He said that he did it because he wanted his workers to be able to buy the products they made. The total increase in wealth of the rich was enhanced by tax cuts. The top tax rates today are half what they were in 1980. The tax reductions, mainly for the wealthy, plus the cost of 2 wars and the Great Recession in the past decade, resulted in a huge federal budget deficit. In 2011, the fight against budget deficits came to a head when Republicans in the House of Representatives refused to increase the debt limit without cuts in federal spending. During the debate on the deficit, we heard lots of rhetoric but precious little analysis. The Republicans argued that taxes were job-killing and that government spending has a negative effect on the economy. Curious about the evidence for or against such claims, I decided to conduct an independent analysis of the effects of taxes and spending on unemployment and economic growth during the years since 1928. The first question was, do higher tax rates on the wealthy increase unemployment? This chart suggests otherwise. The maximum tax rate in a given year is shown by the black line, or sort of black-bluish line, and the unemployment rate by the squiggly line near the bottom. The unemployment rate increased after the 1929 stock market crash, when the maximum tax rate on the wealthy was very low. The tax rate was increased after the fact of the rise in unemployment to stimulate the economy and subsequently to pay for World War II, and remained high for many years. Yet unemployment remained low until the oil boycott of the 1970s and the resulting inflation in the early 1980s. The recent rise in unemployment during the Great Recession occurred when maximum taxes were again relatively low. A similar pattern is seen for maximum corporate taxes. Taxes were low when the Great Depression began, and unemployment was among the lowest when corporate taxes were the highest. Divining how individuals make decisions is difficult for a researcher, but I ask myself, do business people really make decisions primarily based on tax rates? I did a little thought experiment, imagining that I was a business tycoon who received an order for 1.5 million widgets at a profit of 50 cents a widget. Would I refuse to make the widgets to avoid paying taxes if my tax rate was raised from the current 35% to 40%, or even 55%, as Rice proposes? Even if I had to pay 55% in taxes, I would still clear $337,500 in profits. Who would forego such a profit to avoid paying taxes? We often hear that small businesses are the major job creators. The claims heard from politicians and talking heads on TV is that small businesses are not hiring in the aftermath of the Great Recession because of regulations and taxes. A recent survey of small businesses by the Hartford Financial Group does not support the claims. The biggest barrier to success, they said, was lack of customers, not regulation and taxes. As Wright notes in his book, it is lack of demand for goods and services due to stagnated wages and unemployment that keeps the economy in the doldrums. I did a complicated statistical analysis of the simultaneous effects of taxes and spending on unemployment. There is no correlation of unemployment to maximum tax rates when other factors are included in the analysis. A 1% increase in government spending, however, results in a 0.75% reduction in unemployment rates, other things being equal. A more detailed study by economists at MIT indicates that there is a difference in number of jobs influenced by government spending. $1 billion spent on education creates the most jobs, followed by health care and clean energy. Military spending creates less than half the jobs, as does spending on education. Support for education is important for two reasons. There are not enough people with higher education to fill the jobs available for educated people, while there are too many relatively uneducated people for the jobs available. And educated people earn a lot more, a median $48,097 for college graduates and $87,775 for those with professional graduate degrees, compared to $27,963 for those with only a high school education. Furthermore, the U.S. is falling behind in college graduation rates, a trend that hurts our competitiveness with other advanced economies. Our college graduation rates are now lower than 12 other wealthy countries. Too many people drop out before finishing high school. Many are not well trained in high school, and college is too expensive for many who qualify. Rajan advocates increased aid to schools that retain students, increased subsidies to those who cannot afford college, and apprentice programs for those who do not go to college. Rice proposes a voucher system graded according to family income, $14,000 for poor families down to $2,000 for rich families, to encourage exclusive schools to attract more students from disadvantaged families. Not only would such a system produce a more skilled workforce, he says, it would reduce crime and other social pathologies. Rice advocates free tuition at public colleges and universities and fixed percentage loans for attendance at private schools to be paid back with 10% of earnings for 10 years after graduation. Wright says that the historical effect of high taxes on the rich was not so much redistribution of money to the poor, but support for infrastructure and education that provided jobs and a skilled workforce. Primary examples are the interstate highway system and the GI Bill. The size of government is not important if the government is accomplishing goals that the country needs to meet. There are undoubtedly savings to be gained by cutting ineffective programs, but cutting government spending simply to reduce its size can be counterproductive. The Supreme Court has ruled that individuals and corporations can anonymously donate unlimited amounts of money to political action committees not controlled by political candidates. This opens the door to increased domination of politics by the rich. Some even call it financial tyranny. To avoid corruption of candidates, Rice proposes that political candidates only receive contributions from blind trusts so that they don't know who contributed the money. So what is the bottom line? Cutting spending to reduce the deficit will be harmful to the economy, reducing growth and increasing unemployment. Increase taxes on the wealthy to reduce the deficit, as well as support education and stimulate growth, will not harm the economy. And if Rajan and Rice are correct about the wealth gap and speculation in assets, a higher marginal tax on the wealthy would reduce the risk of speculative bubbles in the future.